Hey, I'm Fool.com editor Dylan Lewis, and on this episode of FAQ, we're going to talk pizza and stock splits. Okay, I'm going to offer you two different options. You can have one slice of a 12-inch pizza that's been cut into quarters, or you can have two slices of a 12-inch pizza that's been cut into eighths. Which one do you choose? Think about your answer. While you do, let's walk through what a stock split is. All companies that are publicly traded have a certain number of shares outstanding. Let's say I have a publicly traded company that's worth $1 million, and ownership of that company is divided into 10,000 shares outstanding. So each share is worth $100. Now say my company puts up some awesome business results. We release a bunch of new products, those products sell really well, and customers are happy. Thanks to the massive boost in sales over a few years, the business grows to $10 million in value. Now each share is worth $1,000 at this point. As management, I might look at that and say, that's a lot of money that people need to have in order to become a shareholder of my company. I want to make sure that the average person can buy one share and become an investor. If that's the case, I might decide to do a stock split. Say I do a 5-for-1 split. One share now becomes 5, so the total shares outstanding will become 50,000 for the company, and the price of each share will go from 1,000 to 200. The total value of the business stays the same. The total value each shareholder holds stays the same. The only thing that changes is the number of shares and how much they're worth. That 5-for-1 example was for the sake of round numbers and my math skills, but most stock splits are either 2-for-1 or 3-for-2. Now you might be thinking, why? If stock splits do nothing for the value, why do companies do them? Well, companies might decide to do it to make it easier for the average investor to buy shares. If someone is trying to save $100 a month to invest, they have to wait a lot longer to buy shares if they want to buy shares that are priced at $1,000 instead of $50. This was the main reason Apple cited for going through a 7-for-1 stock split a few years ago. Apple CEO Tim Cook said in 2014, "We're taking this action to make Apple stock more accessible to a larger number of investors." Companies will also do this because there are some special securities like options that are sold in lots of 100. We'll talk about options on a future episode, but for the purposes here, just know that they generally need to be sold in blocks of 100 shares. So if a company's stock price is very high, it requires a lot of money up front to transact these options. Like the previous reason, companies might split their stock to make it easier for people to do that. One third reason that you'll see companies go through a stock split is that it increases the number of shares outstanding, meaning there are more available shares to trade, which can help with liquidity. Now, there are actually some companies that intentionally avoid splitting their stock, and the main reason, stock splits are cosmetic changes to a company's ownership. They don't change the fundamentals of the business at all. And a high share price tends to attract long-term buy and hold investors and actually makes it harder for people to short-term trade in and out of a company. This quote from Warren Buffett's 1983 annual letter to Berkshire Hathaway shareholders pretty much sums it up. Were we to split the stock or take other actions focusing on stock price rather than business value, we would attract an entering class of buyers inferior to the exiting class of sellers. Could we really improve our shareholder group by trading some of our present, clear-thinking members for impressionable new ones who, preferring paper to value, feel wealthier with 9 $10 bills than one $100 bill? Buffett ultimately caved and created a separate class of Berkshire shares in a split, but he's never split the voting Berkshire A shares, which currently trade at over $300,000 each. More management teams are starting to think like Buffett. In 1997, over 100 companies in the S&P 500 split their stocks. In 2016, that figure was down to 7. Executives are wising up to the fact that stock splits aren't worth their time, and the rise of brokerages offering fractional shares have made it easier for investors with less money to still get into the market. You'll hear people say, "Oh, stock splits are a bullish sign. It means the company thinks they're going to keep growing and the share price is going to keep going up." No, it's just shuffling around how ownership is held. Going back to our pizza example, some people might prefer to get 2 smaller slices instead of one monster piece of pizza. But the reality is you're getting the same amount of pizza either way. The same goes for a stock split. There may be some short-term movements related to the news, but long-term, shares move because of the business results that companies put up, not the number of ways ownership is sliced up. Thanks for watching, guys. If you enjoyed this video, we've got plenty more like it coming up. Hit subscribe down on the bottom right and give us a thumbs up. And if you have any questions on things I hit in the video, drop them in the comments section below. We love getting ideas for future videos.